Okay.
Sticking with retail, our next guest sees some volatility, but he's got 3 dividend-paying names he thinks can weather the storm. Let's turn now to Hennessy Funds Chief Market Strategist Neil Hennessy. Neil, welcome. And where's your mind at as we kind of count down the, 80, 70 days till the election? And a couple of weeks ago, Amazon and everyone was telling us election uncertainty was an overhang on consumer spending. And today it feels like the mood is totally the opposite.
Well, you got to sort of look at everybody for the last couple of years, economists, analysts, everybody. I'm just an economic realist, Kelly, but essentially they're predicting a recession. You can't have a recession with high unemployment, without high unemployment. You know, they're going to cut the rates. Everybody's just out there trying to guess what's going to happen. And then you look at the numbers today on the employment side. We were still averaging 175,000 new jobs a month. That's good. There's still more job openings today than there are people to fill it. So looking forward, I don't let the political landscape, push me one way or another. Actually, I try and turn it off and just look at value and where can you invest the shareholders' money so that they can make a profit.
Well, and understood. I mean, and I think most people would on some level agree with you, but they go, okay, if I have to consider it, I'll consider. I mean, even things like the proposed capital gains taxes, those issues that would be kind of more squarely in the investment wheelhouse. Do you pay attention to those, or do you think that's just a lot of talk and not much is going to actually happen?
There's not a lot I can do about it, nor anybody else, until it's actually enacted. If you look at one of the roughest spells that businesses had was under President Obama's legacy, where more rules and regulations came in, Kelly, than ever before, but we weathered the storm. New taxes, tariffs, this, that. Until we actually see it, there's no reason to go gamble when you can go buy value. As I told you before, the Magnificent Seven, that game's over. People are now shifting to value. And after you see what the Feds are going to do, and everybody's predicting maybe 100 basis points, maybe 6 cuts by the end of the year, come on. The best I think we're going to get, Kelly, is a sympathy cut, 25 basis points, and let it play out because the economy isn't as bad as the headlines are telling you.
Is the Magnificent Seven, let me try to pull up our CNBC index, is it really over, Neil? Because if anything, that's been leading the rebound since that recent sell-off, whereas the Russell keeps underperforming.
Yeah, sort of look at it. Look at the Russell Midcap. It's up under 10% this year. The Dow Jones is up less than 10%. You're looking at the Magnificent Seven, 8 stocks, okay, that make up 33% of the S&P, 43% of the NASDAQ 100. Come on, Kelly. Once you get overweighted that way, you know the game's over.
I know, but
euphoria.
But listen, I'm on board with you intellectually. I'm just watching the market action.
Well, short term, I don't know where the market's going to go or these are going to go short term. I'm trying to look long term and say, are you going to be able to play tomorrow or not? Maybe you are, maybe you aren't. You can look at the carry trade 3 weeks ago. Everybody thought that was the easiest trade in the world. And then it comes to the point of unraveling, and everybody's going, oh, Lord, what's going on? So I'm just looking at the mid-cap sector is where people should be putting their money, because if you look at it, so far this year, $120 billion have come out of stock equity mutual funds, and $10 billion has got in the money market funds. If rates come down, that money's going to come out of money market funds, and where are going to go? I would assume, and I would think logically, it will go into the mid-cap sector.
Well, I know that you're hoping so, at the very least. You do have names from a kind of across the economy. You like Oshkosh, the industrial. I think that's an industrial. You've got Group 1. You've got Guess. I mean, you've got a retailer in there, but my guess is that I assume that's less about, kind of what's going on with consumers more broadly and more about the valuation for you.
Well, I think, it's all about the valuation. You look at all 3 of those stocks, they all have a PE of half of what the market is at 9. Their price to sales ratios are 0.3, 0.4, so you're buying them at 30, 40 cents on the dollar. They pay dividends. They're making a ton of money. And the one thing we've talked about numerous times, Kelly, when you look at the mid-cap sector, they are big enough to weather economic tsunami, a soft landing, hard landing, whatever you want to call it. They're also big enough to be bought. by somebody to be accretive to somebody else. They're
True.
also big enough to make an acquisition to be accretive. So why go risk and gamble on 7 stocks when there's so many other good companies making a ton of money and cash flowing than just 7 companies?
But they want